Hi, everyone. Welcome in. I'll give a few seconds for everyone to join. All right. Hi, everyone. Welcome to the first session of day two of Definity Academy. We'll be talking about positioning your retirement plan for what's next. I'm Ashley Schuhart. I am Marketing Director at Definity, and we are so happy you could join us today. Before we get started, just a quick housekeeping note. If you have questions at any point during the session, please drop them into the Q&A feature. We will be keeping an eye on those throughout the session, and we'll leave time at the end to address as many as we can. So now I am excited to introduce our speaker, Debbie Snap. Debbie is Vice President of Business Development at Definity and brings more than 25 years of experience in the retirement plan industry. She founded and successfully grew qualified plan administrators before joining Definity, where she continues to help organizations design retirement strategies that truly support their goals. What really sets Debbie apart is her ability to translate complex plan design and regulatory changes into practical, actionable strategies. So that's something you'll see throughout today's session. In today's presentation, Debbie will walk us through how employers can take advantage of current opportunities and optimize plan design for greater impact. So, Debbie, we are so glad to have you, and I will turn it over to you.
Thank you. The first thing that I wanted to talk about was the actual tax credits. And I know that we have both sponsors and we have advisors and salespeople, different people on the on this call, but one of the big things is that small business tax credits for retirement plans have been around for a while. But since 2000 Secure 2.0, they have really been enhanced. And what's been discovered is that there's really a disconnect between when they're first sold and you turn around and do your tax return, months later after you started a plan. And so since I don't know how many people are familiar with this or how many people currently have fairly new plans, I'm not going to spend a lot of time on it. But the main thing that I want you to realize is that if you actually started a plan in the last couple of years, make sure you get with your tax advisor and uh, confirm that you're taking advantage of this because I'm a CPA. I used to do tax returns in my previous life, and most of the time, your accountant is not aware that you may have these things unless you tell them. So, as you started up a new plan, if you didn't let them know that there was certain costs that you might be incurring that would you could get the tax credits on, then they don't know about it. There's four areas that um, 2.0 on the current retirement plan startup credits is that the first one, startup costs, that one's for 3 years. And uh, basically, that would be any administration costs like TPA cost or investment costs that you incur. And I'll get into a little bit more detail with that. The second one, the contributions, this is a Secure 2.0. It did not used to be in the available tax credits for small businesses. It is phenomenal. And so, even if you have a new plan and find out that you didn't get it communicated to your accountant the last 2 years, that you might be, eligible for this, it would not hurt. It would be worth amending the return just to make sure you take advantage of the tax credit. The military spouse, I haven't seen that one because the area I live in doesn't really have bases, so that doesn't come up a lot. But if you employ military spouses or your company's in a town that has a lot of military in it, therefore military spouses, you should look into that further. And the last one's auto enroll. and you get $500 for the first 3 years, you do not have to have a new plan for this one. You can have an existing plan that you may have had for a long time that doesn't have the auto enroll feature. And you can add that on, and that will allow you to get that $500 credit for 3 years. And so, we'll, uh, Ashley, go on to the next. Um, this is how the startup costs are done or calculated. If it's 1 to 50 employees, you don't count the owners. And so any non-highly compensated employees times 250, that is going to be your maximum credit. So it would be the lesser of $5,000 or 250 times the number of employees, and you compare that to what you spent. And so it's 100% credit. And that what people need to realize is that a tax credit goes directly against their tax liability. You don't get a deduction and the credit, but that completely cuts, your tax liability on that. So credits are very good things. If you've got between 51 and 100 employees, you still get a 50% tax credit. And so both of them are still good. They can't make it any of these rules easy, but that's the way that this one works. And like I said, this is like company cost to start up a plan. So that would be directly paid from the company, TPA cost to different investment platforms, things like that, anything to establish your plan. Okay, this is the one that is fantastic. And I was so surprised when they came up with this because I always felt like, getting to deduct any employer contributions was a good benefit in itself. But they're really trying to encourage more employers to have retirement plans. So, what this credit for employer contributions, they take the first $1,000 for any eligible employees. And of course, they have to make different rules for this than they do for the previous credit. I'm not going to get into the weeds on that, but basically, most of your employees. Um, the first $1,000. So if you've got just even a simple plan that may have a match in it, that you're matching $2,000 of what an employee defers, 1,000 of it would get to be a tax credit. And this one lasts for 5 years. And so that's a very good one. It may be another reason that you might want to look at, in addition to match, other employer money the first couple of years because you can get that tax credit, which, greatly reduces the cost on it. So that Ashley, you can go on. Um, the auto enrollment, this is the one credit that you can have that even if you established your plan 10 or 15 years ago and it doesn't have auto enrollment in it, the government is all over auto enrollment because they well, I won't put my personal opinion in it as much, but pretty much they think that a lot of people do not take their retirement savings seriously. So if they won't fill out a form and you automatically start deducting from their check because they didn't fill out a form, then they'll at least have savings. Um, the flip side of that is that I try to encourage people, if they add the auto enrollment, make sure that everybody signs a form, even if it's to say, I do not wish to defer at this time. And the reason for that is that if you're ever audited, you just need to prove that if somebody was eligible and that you gave them notice that they were going to be enrolled and that you actually enrolled them if they didn't return the form back in. That being said, I think that from a practical matter, the best thing to do is treat it like other employee benefits, for instance, health insurance or whatever, that they have to proactively do something. And so it's just a different way of thinking. I think in the past, people would look at their retirement and say, well, I told them about it, if they don't fill it out, that's fine. But this is still, it's a little, if you feel like that with your employees that they're not doing what they should and you would like to get more to participate, you may want to add this on and that you could get that extra $500 as a credit that you wouldn't otherwise have, even if you've had it for a while. Okay, this one, and back to the tax credits. If there's questions later, like I said, I wanted to make that very brief. It's complicated. Sometimes when you end up talking to your accountant or something, they may not understand it and they may need to talk to your retirement consultant just to get some of the numbers because I've looked at the form. The form's not easy to read. The plan sponsors just need to make sure that all of their parties are aware that they have a tax credit that they can utilize if they're eligible for it. Now, optimizing your current plans. What I want to go to on this is for people that have had plans and that they may have had them for a while. They're not sure what all their plans can do. It's very confusing when you first establish a plan because you're getting a lot of information at one time and you may not realize, what all the plan can do. And I can give you many examples of clients over the years that have said, "Well, I may want a profit sharing plan," and I'm like, "You have a profit sharing plan. You've never utilized the profit sharing component in your plan." And so, almost any 401k plans you will find have the ability to do profit sharing. When you first establish the plan, you may only be looking at, I'm setting this up for the employees and I want them to be able to defer and I'm willing to do either the 3% non-elective contribution or perhaps the match. These are the two safe harbors of dollar for dollar up to 4% or the other, basic formula, dollar for dollar up to 3% and 50% from 3 to 5. Anyway, you could be on autopilot doing that, and over time, your business may be doing better, and you have not realized or thought about the fact, hey, I'm more profitable now. Should I be doing something else? And so, what I want to show you on this is for maximizing your retirement plan, when you get your data request at the end of the year, one of the questions may be, do you want us to calculate a profit sharing contribution for you? One thing that you need to realize is that just by having it calculated for you does not obligate you to do it. And so I know that in the past, I've always worked directly with my clients' accountants, and many times it's the accountants that will say, hey, can you calculate a $50,000 profit sharing and show us how it can be broken down for, this employer. She needs to get rid of some profits. And so the thing on profit sharing is it can be a dollar amount, it can be a percentage. And I know that the plans that I've established, and I'm trying to say this generically just because since I'm so new to Definity, I don't know like if everybody's how when their plans were originally set up, if they all have the everyone has their own rate group as the profit sharing formula. But if you look at this profit sharing on this spreadsheet, this is basically the way that profit sharing works. And I'm illustrating three different types of formulas just to show you the breakdown, if you wanted to add it, of how it could look. And so the pro rata, it says 20%. This part's assuming that you don't have any 401k in it. And I'll show you that in a second on the other part of this slide. But on the pro rata, the owner could get up to 72,000. That required 20%. And so if he got 20% on a pro rata formula, everybody got 20%. And so it's the same percentage for each employee. And if you notice at the very bottom, the owner group, which would include both the owner and the spouse, are basically getting 75% of the benefit. So depending on what your tax bracket is or something like that, or how much you like your government, most of my employers will say, I'd rather give it to my employees than the government. And so sometimes it's worth just looking at to see, you know, what the breakdown could be and what you could get. For the pro rata, that is, you know, you want to give the same to everybody. And I'll explain the other two and then I'll tell you the difference. But the next one, it says integrated with Social Security. What that means is that this is still a traditional formula, but basically they set it up where if you made over the taxable wage base, which I think was the 184.5 in 2026, then you can get, if you're doing a straight profit sharing, you can get an extra percentage yourself for the amount over the taxable wage base. I think the premise behind it originally was that you're being punished by not being able to put more into the Social Security system, which I don't know that many people want to put more into the Social Security system, but that's why they came up with this approved formula. And so the first one, as I said, everybody gets the same. The second one, anybody that's making more than the Social Security wage base may get a little bit more. And if you notice that 20%, it ended up for the employees saving about $4,000 just by, integrating it with Social Security. This last column, the new comparability, this one is the one that can be stellar when it works. And the biggest thing that anybody has to realize on this is that it's based on the demographics of your employees and yourself. And so you've got two groups, the owner group or the highly compensated group, and that then the rest of the employees fall under non-highly compensated group. And so what you're doing is you're basically the best way that I can explain it when it says everyone has their own rate group, I tell my employers, we need to know the goals of the target group, and then we will let you know how much that you have to fund for the rest of the group based on your goals. And so in this case, the owner, we want to maximize him. We wanted to get him to the $72,000. So what what I would do in that case is how much do we have to give the employees? If you'll notice in the first column, we've got ages in italics. Pretty much as a rule of thumb, if the second group on average is at least 10 years younger than your target group, you're going to probably get good percentages, with this new comparability formula. Now, if a new owner came in and bought out the current owner and he was, you know, 25 years old, you would probably have to use one of the traditional formulas because you're never going to get these same uh, numbers that work out so nicely. If you notice, I put the percentage in the last column. All of the employees, we only had to give 5%. The two owners were able to get up to 20%. And so that this one is ideal, but you've got almost a 20-year gap between the owners and the rest of the group. And this is keeping it somewhat simple, but you can't look at a single scenario, like even if you were initially looking at it during a sale and saying, oh, this is great. You can't go in and think, oh, I can always do this. Because each year, as your workforce changes, then that could change how much you're allowed to do, but it's very much worth looking at it. In some cases, what we would do is that if we weren't coming out ideal and you had two highly comps like this, the owner and the spouse, we might put the spouse at a lower level just to keep the overall cost down. And so, what you want to remember on that is if you're looking at profit sharing, you would want to set a goal. Like the owner's goal could have been, I want to put in $50,000 this year. Then all of the non-highly comps would have to get, a certain percentage based on getting the owner to that goal of $50,000. And I just want to stress on this, there's always a good way to do a profit sharing. There's a lot of rules. The best thing to do is to talk to your consultant each year. If you've had a good year, you want to see your choices, then say, let's look at profit sharing this year. What can I possibly do? And I do think it's usually a good goal before you talk to your consultant to possibly see how much you would want to do, because they can always calculate a maximum, but in your head, if you only wanted to get rid of, $20,000, that's a totally different calculation. But if you look at that percentage at the very bottom of this particular column that says new comparability, the owner group's getting 92%. That's a slam dunk. I mean, because only 8% of it is going to the employees. So your tax savings more than covers, any costs that you would have to put in for the employees. And so that's the best type. I showed in that part just the profit sharing as if that's all of it. But if you look over in the next group of columns, if you have the 401k, what that does is reduces the amount that you have to fund as profit sharing in order to get to the maximum. And so if you look at that case with 401k with ER contributions, the owner's 57. He could get a total of 32.5 with his catch-up contributions, which is 24.5 for 2026 with an $8,000 catch-up. In addition, he has the 3% safe harbor. And so the safe harbor is what you have to do in order to get the maximum 401k without testing. So the new comparability column or the profit sharing column, that 36.7 is what it takes to get him to the maximum limit allowed by law for one person. So that's what that number's all about. If you notice there, on the percentages for the employees, it still has that same 5%, but 3% of it is the safe harbor and the additional 2% is profit sharing. And so overall, he's still saving. Number one, by having the 401k, he's able to get the catch-up contribution of $8,000 plus 8,000 for his wife, and still maximize his profit sharing. And overall, the owners are getting 94% of the total outlay of cash. If you notice down there, I reduced the employee deferrals from that total of 131.3 because the employees' deferrals come out of their checks. So that's not an employer cost. So this is the best way to look at the total to see how much the owner group is getting. But I know a lot of this can be confusing and complicated. What you need to do is say, has my current plan been doing what I need it to do because I want to get more in and I need more tax savings, or I'm getting older and realize I don't have as much in my retirement as I need to? So, if, Ashley, if you go on to the next one, this is a real case example of one of my clients. And the funny part about it is that this particular client, he always had the match, which dollar for dollar up to 4%. I like the enhanced match because it's easy math. And so, what each year at the end of the year, he wants to do a profit sharing in order to maximize. And so, based on the what I showed you in the previous slide, he comes out that he can get a very good percentage by doing the match for the employees. Then at the end of the year, he's probably doing the 5% profit sharing for everybody else in order to get the maximum. One thing I don't have in this, but just as an extra note, this particular owner, if he was 62, he can do something called super catch-up contributions, but they just have so many rules you can't put them all in one slide. So anybody between 60 and 63, make sure that you're taking advantage of, if you're doing elective deferrals, your super catch-up contributions. But anyway, with this scenario, same thing, small group. And if you'll notice, he does have like at least one employee that's older than him. So that's not going to necessarily kill everything. And trust me, you don't want to sit there and say, well, I really want to get a lot in profit sharing, so I'm going to hire a lot of young people and forget about the older ones, because in my case, we had had so much trouble trying to find good help. I don't care what their age is. I would rather pay the extra benefits just to get good employees that would stay, but that's just me. Um, anyway, this total in his case, he's getting up to, this is 2025, by the way. The other one may have showed 80,000. It was based on 2026 numbers. These numbers are 2025 numbers, so it's a little bit different, but the same premise. And so in this case, take out the employee deferrals, still getting 85% of the benefit. And so I'll show you one tweak to this on the next slide. If it says change to the 3% non-elective, what that means is that this client was on autopilot with the match. He had the match every year. He wanted to reward the people that were actually deferring. But when he switched his goals to say, you know what, I need to maximize my profit sharing because I'm getting older, this is when we may look back and say, maybe you need to change from the match to the 3% non-elective. And the reason you would do that is that the way that all of the testing works, which takes very nice, expensive software that's much smarter than I am, and you have to plug in all of these different things with it, but that and the regulations by the IRS, the 3%, since it goes to everyone, counts for that ER testing number. If it's a match, which only goes to the people that actually make deferrals, then that doesn't count towards that testing number. So overall, the in this case, he's going to save money by doing the 3% because his ultimate goal is to maximize his retirement. And so he goes from the total outlay, it saves about $7,000 from having the safe harbor match and profit sharing to switching to the 3%. He's going to save about $7,000 overall towards the total outlay of cash. So he's going to get an 89% instead of 85, but the total outlay went from 130 to 123,000 more or less. And so that's something else whenever your goals are changing. You've had the plan for a while. You may want to look at something else. These are the kinds of things that you need to talk to your consultant about to say, hey, how can I make my plan better? And let's look at some of the options. Okay, let's go to the next one. All right, now this one will tee you up for what's going on in some of the other uh, classes or whatever you want to call it after this one. But this is another real example. I had a client that for years was always maximizing his 401k plan. And so uh, he would maximize it. It was just him. And then all of a sudden he's getting a little bit older and he's saying, you know what? I think I want to be bought out in a few years. And he wanted to sell to some of the long-term employees in this professional business. And so what he did was he added the cash balance plan, and the way that it works, and I'll try to keep this, in this case, the minority or owners that you see at the left-hand side are buying him out. So he's getting extra cash in addition to his plan compensation, and he wants to take some of that extra cash where they're buying him out and put it into retirement. Therefore, he established this cash balance plan. And the actuaries, they can give you a lot more details on that. I always say that they're much smarter than I am, that they have to work with different scenarios and everything. But the way that it works is sort of like I was talking about on the new comparability. You would look at it and you would say, what's my goal? How much can I afford to be putting away into retirement per year? And you would build the plan around that goal. And so in this case, he wanted a cash balance benefit of $100,000, but still at the same time, he was trying to maximize his 401k, which gave him a total of 77.5, which was the maximum limit. You'll notice that most of the minority owners, they weren't getting any additional benefit on the 401k side because once they became owners, he was saying, what do you want to put in? And the amounts that would have to go to the non-Holly comps were based on their goals. Well, most of their money's going to buy him out. Therefore, right now, their goal is to try to get the maximum 23.5, 24.5 per year into 401k. We've got one really good saver there that wants to maximize. So she puts in the full amount of the profit sharing, but the others aren't. And so that would be another conversation that you can build your plan design around what the goals are of the target group. So not just the majority owner that's added the cash balance, but for the rest of the owners. Because if you've got your small doctor's practices and everything, you may have new doctors coming out of school. They're younger, but they may not have the goals or they may not have the extra cash because they're paying off all this student loans. And so this is the part that you need to see what are the goals, and don't just assume that everybody in that group has to do the same thing because you do have choices. But in adding the cash balance, the main thing that I've got to say, one thing that I've seen, you hear people will hear, oh, cash balance is the greatest thing. But many times they're not even maximizing their 401k yet. So the cash balance is an obligation, not, you know, the 401k, you can always decide in the regular 401k plan, oh, this year I'm not going to do a profit sharing, or I am going to do a profit sharing. The cash balance calculation is based on a, a number of things, the earnings, the amount of cash credits people are getting. That one's a given. And so many times people will get in and they'll say, I don't want to fund it all this year. And I'm like, no, you signed up for it. You have to fund that one. You don't necessarily have to fund your profit sharing. But the bigger thing is to make sure before you set something up that you understand and make realistic goals of what you do want to accomplish. Because although the person, I think that uh, the majority owner at 60, he might could have gotten a cash balance benefit of 300,000, but he chose 100,000, and between that one and the 401k plan, he was able to get 177.5. So that was his comfort level. And so that is what you probably need to do as you're looking to decide what it is that you wish to accomplish with things like this. But the biggest thing that I would say is that as you're going through changes, he was going from an owner to wanting to sell his business, but he wasn't ready to quit yet. So he wanted to find a way to get more in for himself that could help his retirement. And so overall, this is a different way that you can utilize another plan, i.e., a cash balance plan, in order to reach your goals. Now, whenever he does reach his goals, then the whole practice may not keep the cash balance plan. You usually need to try to keep them in place. I think 5 years is the standard. You don't open it up just to shove a lot of money in one year, but it can really be worth the cost if your goal is to get quite a bit more in retirement because you're trying to catch up for years that you didn't save. Anyway, I don't know if anybody has any questions.
Yeah,
Uh,
thanks. Thanks, Debbie. We do have a few questions that came in.
okay.
One, it goes back a little earlier. So for the credit on auto enrollment, is the number of employees based on enrolled size or eligible size?
Oh, I think it's eligible employees. If you look at the actual, it's number of eligible employees. So somebody can't have like 150 employees that are eligible and only 20 are participating and still get it. So it's meant to be a small business tax credit.
Great, thank you. And then this question came in around the same time as that one. Is that $500 per company or $500 per employee?
Oh, on the auto enrollment,
I think so. I think that's about the
uh,
time it came in.
on the auto enrollment, it is for the company. That's the total for the company. If you add that provision, it doesn't usually cost anything to add the provision, but you're going to get a tax credit for adding the provision.
Great, thank you.
And so,
Okay, next question is the comparability formula an either or for owner versus highly compensated employee?
um, the new, you look at the whole plan, and you've got two groups of people. You have your highly compensated employees and your non-highly compensated employees. I had small examples just, for illustration, but if you take a group that perhaps has, you know, 10 highly compensated employees and only two of them are owners, then yes, each group, many times the owners want to maximize themselves. They're willing to give more to their employees, but not necessarily more to their other highly compensated employees. It's funny, probably one of the groups that um, really emphasize it are the ones that have that middle group that I want to call, like in the anesthesiologists, the CRNAs, or the nurse practitioners and some of the other practices. It's like they do not mind giving to their rank and file. And the owners, which are usually the physicians, want to maximize, but they don't want to give anything else to that middle group because they're a pain. I'm just paraphrasing what some of them say. But no, you do not have to do all of the highly compensated the same. And there are going to be highly compensated that aren't necessarily owners. Is that
Okay.
what you think they're, does that
I,
answer
I
it?
I think so. We can wait a few minutes here, a couple seconds here, if anyone has any final questions, or Nick, if you have a follow-up there. But um, we'll just give it a second or two. Otherwise, I think we're through the questions there, Debbie.
Okay, and I think that Ashley at the end of it, she had put my email address because I know sometimes people don't like to ask in groups or they may want to look at a different individual situation. So anyone is welcome to call me or just send me a quick email and I'll try to answer their questions because I know that this is complicated material that it's hard to absorb it all sometimes.
Yep, I have your contact information up on the screen. So thank you all so much for your time today. Thank you, Debbie, for your time today. Definity Academy Spring Educational Series is back at 1:30 Eastern with a session on how cash balance plans can benefit high income earners. So a nice continuation of what Debbie teed up for us. And then Thursday, we have two sessions for plan sponsors. One is our mid-year essentials on how to keep your plan on track and another on how 316 fiduciary services can minimize your risk. So we look forward to seeing all of you again shortly and tomorrow. Thank you all for joining.
Thanks.